Hello and welcome back to the ROI channel, the channel that's obsessed with all things to do with the art and science of return on investment. Today we're talking about the Crassus investment portfolio on eToro and one of the stocks in which we own. So if you haven't checked out the portfolio, click on the link below and you can add it to a watch list. Thank you for everyone who's already liked and subscribed to the YouTube channel. If you haven't done so, would greatly appreciate you doing so now. That helps me to get more and more of these analyses out there. And leave a comment if there's anything that you would like me to look at and go into and give my thoughts on. So without further ado, let's get into it because we've got a really big one to go over today. I'm very excited about this particular business, CF Industries. CF Industries, along with every other asset in Crassus Investments fund, goes through our investment formula. So what is that formula? Quick recap. We're looking for businesses with low debt, margin of safety in the terms of the quality of the business and terms of the price through which it's trading, as well as the discount metrics which we use when valuing such businesses. We're looking for a history of sales growth or projected sales growth in the future, the ability to maintain strong margins or expand them. Free cash flow growth allows the business to continue to grow and reward us as shareholders via dividends, or even more so through share buybacks. Okay, so that's what we look for, and we're going to get straight into it today and see how CF Industries stacks up using that formula. So initially, it's worth noting CF Industries is a cyclical business, the world's largest nitrogen fertilizer producer. Okay, so the demands on the production are obviously going to be consistent with the demand for agricultural supplies. So farmers growing particularly corn, grains, those sorts of things need a lot of fertilizers, and so in the good years when things are pumping for the farmers, they're going to be ordering more fertilizer, and then you're going to go through some peaks and troughs depending on the cycles. So over the last 10 years, the company has been able to grow its top line revenues at about 4% compound annual growth rate, and that's been smoothed out. So usually you'll see these big cycles of boom and bust. EBITDA is around 2.2 billion. Slight margin creep there at 2%, but we believe that's going to increase into the future. Market cap currently 9.7 billion US, enterprise value 15.6 billion US, and the share price is not 28.84. That's hasn't changed with OneNote. It's actually $45.43. Shares on issue is correct, 215 million. And interesting to note, the history of share buybacks since 2010, this company has reduced its shares on issue by 66%. So they've gone out and they've bought back 2/3 of the business. Return on capital is around 8% over the long term. If you look over the boom years, it's much more than that, and it currently holds a net debt to EBITDA of 1.7 times. Price action over the last year, as you can see, we're in and around the median for 12 months. And if we look over a longer time span, so what's that, roughly 15, 16 years, you'll be able to see currently trading $45.43. And you go through these real cyclicalities. So it's shot up after listing, it's just gone through boom years, then you've had a decline which has been in lockstep with the agricultural futures prices, because that, as we said, is tied, or the price of the business and performance of the business is closely tied to the performance of the underlying commodities that they're related to. And here is where they started their share buyback. So from 2010, they've reduced their share count by 66%, as I mentioned. Now, right at the peak here, this is very interesting. At around 2015, the company invested $5.2 billion in increased production. Okay, so they had $5.2 billion outflows in capex to increase their productivity capacity by, I believe it was about 25%. So why is that important? Well, the share price fell off a cliff after that, and if you look at where the price has recovered to today, we are getting in at a lower price, and the company's already paid out for the capex, so presumably there's really not a lot left to spend in terms of increasing the production of the business. So we get all that value. We get the ability of a new and improved business to increase production, which means increased cash flows, increased depreciation and amortization for the equipment and the production manufacturing housing for that which in which they've invested. And remember, we've got a 66% greater claims on the cash flows simply by the history of buybacks of the company. So very good management in what is a competitive business and cyclical business. So the management is giving us a lot of signs that they deserve our confidence. What's the qualitative rationale? What's the outlook for agriculture and in particular CF Industries? There are some other fertilizer producers out there like Fosagro, of which I'm a fan, but I don't own Fosagro. I believe CF is the best way to play this moving forwards. Currently, people still believing that resources are plentiful, natural resources. Well, what tends to happen is as the resources get more plentiful, then the farms are disincentivized to plant more crops. And so then you start to have a supply shrinkage, and demand stays relatively inelastic. And if you think about it, it doesn't matter what the economic circumstances are, people still need to eat. So your demand is at least constant, if not slightly increasing alongside population. And with the ascent of middle classes in areas around the world that traditionally were a lot poorer, they have more money and disposable income to spend on agricultural products, so food, to be able to feed their families. If food prices shoot up, that then starts to give, from an undersupply, gives the farmers incentives to plant more crops, and then that's where you go through these sort of oversupply, undersupply cycles. We've touched on CF's shareholder value history. They're a very shareholder orientated company, which is great. That's exactly what we want. We think that actually there's going to be a supply-driven bull market in commodities. The competitive advantage that CF has is it's actually one of the lowest cost producers, and so being situated in the United States, they have access to cheaper natural gas, although natural gas has certainly increased. But for example, some of the other big fertilizer producers in China are relying on liquefied gas, which is more expensive. So being the biggest producer in the world, they've got scale advantages, they've got infrastructure advantages, and they're in a better position, I believe, to take advantage of the commodities bull market, particularly in foodstuffs. Touched already on the history of the company. 5.2 billion in capex has already been spent, so we as shareholders now are getting the rewards for nothing. It's already been spent, and we get to reap the rewards of the increased production. If you look at the cash flows, this company could actually maintain and pay a sustainable dividend yield of around 5 or 10% without suffering from a lack of capex, which is obviously a really good sign moving forwards, because there's so much cash flow that the company is set to produce that they'll be able to either buy other companies, buy back their shares, increasing our claim on the cash flows, or just dividend that cash flow out to shareholders as a direct payment. And nitrogen demand is set to continue to outpace the supply over the next 5 years, which means that people are going to be wanting what CF Industries has to sell. So if we look at the relationship here between the corn futures and CF Industries, there's a very close correlation. So corn futures here in blue and CF Industries here in orange, you can see they track each other as we've spoken about. It's basically hand in glove. However, you'll notice here that CF Industries was more of a call option on the corn prices, meaning as futures rose, CF Industries traditionally has risen more, and that makes sense because it's a producer rather than just the pure commodity itself. So people will be paying multiples of the cash flows that they produce, being a business. But if we look up here, corn futures are outpacing CF Industries. So if we were to get a mean reversion, that alone should suggest that the price of CF Industries would jump. Okay, moving into our short-term projections, looking out to 2022, the free cash flows, the EBITDA, and the expected earnings for the end of 2022 are down there on the left-hand column. And here we have industry median multiples for all three metrics. And it's interesting to note at the moment that the free cash flow multiple is something like 6 times for this business. You're paying 6 times for the cash flow of the biggest nitrogen producer in the world. So that seems to be dirt cheap to me. And if we go through and we simply multiply the expected cash flows, EBITDA, and earnings by their respective industry median multiples, these are the prices which we would expect and the relevant upsides. If you add those together and just simply weight them evenly, divide them by 3, the average upside I'm expecting is around $80 by the end of 2022. Now, that doesn't necessarily mean we'll get the timing right, but it's really a good vote of confidence, meaning that we might have a 76% upside in a very short period of time, particularly if this commodities bull market continues to increase. And given the degradation of paper currency purchasing power, there will be, I would expect, a continuation of the bull market in commodities where people are looking to get out of fiat currencies and, even from an investment perspective, to be able to put their money into something that has some real tangible value. And of course, the good thing about grains and corn, etc., is that you can always eat them, where you can't eat paper. So if we look out into the future and we apply historic growth rates for CF Industries EBITDA, and we use enterprise value to EBITDA as probably the best metric, I think, for this company, and we buy the shares today at their current share price, and we, on a per share basis, receive this amount of EBITDA. And yes, I know that that's not a perfect metric, but I think it does apply when you take away the depreciation and the amortization for CF Industries. They've got a low debt and they've already spent on the capex, so the earnings will look artificially low, in my opinion. So we'll use the EBITDA as our best metric, discount those future EBITDA earnings by the company's current weighted average cost of capital, okay? And this is what we expect to receive as an internal rate of return, okay? So if all comes to fruition, that means that if we buy the shares at the current price today, we should expect as an annualized rate of return 22.68%, which is really, really good, okay? You're doubling your money every sort of 3.5 years with a rate of return like that, which you can't find in too many places around the world at the moment. So if we use a few other metrics, we've got our standard probability weighting here, where we have a base case, a bull case, and a bear case. And if you follow my cursor, I've assigned those given probabilities to each. And we do this for free cash flow, earnings per share, and the EBITDA. And then we average those and see what we can get using a discount rate of 20% for all of those valuation methods, and using historic growth rates and terminal multiples for the base case of each, and then doing basically our best guess when it comes to the bull case and the bear case. Obviously, we give it a little bit of leverage in the bull case, and we haircut our expectations over the bear case, asking ourselves, okay, well, what could go wrong, and what might the numbers look like in that scenario? Down here, this is the EBITDA that I'm measuring here at the expected growth rates, and we get 93.9 as an expected intrinsic value. For the free cash flow method, we get about $50.73, and the earnings, which, as I said, takes into account a lot of depreciation for a business that's quite capital intensive, it understates the value at $48.76. So the average of all three metrics suggests that for us to get our required 20% return on investment, we need to buy the shares at $64.46 or less. And obviously, the lower the price, the higher our expected returns. Margin of safety, can we buy the shares at 2/3 to that, in effect creating a double whammy effective margin of safety. That price there is only a smidgen below where the shares are currently trading at. So that's what's got me so excited with CF Industries, and I've put quite a heavy allocation to the shares in the Crassus Investments portfolio. So that gives it away. What's the verdict? Definitely a buy for me. We got in at, I believe, around $44 as an average entry cost, and I'm continuing to buy some more. I'm seriously considering bumping that percentage up to more like 5% of assets under management. So it certainly does satisfy our Crassus investment formula, being that it's got low debt, it's got margin of safety in terms of the price and the qualitative aspects expected in the future. It's got sales growth, strong margins. They should be expected to grow, okay? If you look at shorter timeframes, those margins that I mentioned at the start of the video will be up by a factor of nearly 10. It's just when you look at a 10-year history, that takes into account the troughs as well as the peaks, and that brings down the overall compounded annual growth rate. So if we're thinking into 5 and 10 years ahead, particularly 5 years, we would expect some really healthy margins and free cash flow growth, and absolutely a history of share buybacks. And the free cash flows expected will allow for further buybacks should the management deem that appropriate. So currently at about 4.5% assets under management, and as I said, I'm seriously considering, if the share price drops or if it continues just to sort of go sideways, bumping that exposure up to even 5% of assets under management. Thanks for watching. If you haven't subscribed to the channel already, I would appreciate that. Follow me on Twitter if you want to keep abreast of what it is that I'm thinking in real time. And if you would like to invest and copy the portfolio, just click on the link and that'll take you to the eToro website. If you don't have an account, you just download the app, and then I think for a minimum of $200, you can copy the portfolio. So really great initiative. I love it. The fund is doing very well. So thank you to the people who are already copying the portfolio. I'll continue to keep you updated and take you through my analyses. As always, disclaimer, do your own due diligence, and don't just take the word of someone off the internet. So always up to you to do your own due diligence, guys. Be sensible, be smart, and I wish you all the best with your investing. I'm going to leave it there, and I'll be back with another video at a later time. Take care.